As per Ind AS 109, an entity will recognize financial instrument when and only when it has become party to the contractual provisions of the instrument. If there is no contractual rights and obligations related to an instrument as per Ind AS 32, no financial instruments will be recognized by the entity. So this is general rule about the recognition of financial instruments on the balance sheet of the entity, but there are some exceptions also to the general rule that will be discussed later. Entity recognize unconditional receivables and payables as an assets or liability when it becomes a party to the contract, and as a consequence of that contract, entity has legal right to receive or a legal obligation to pay cash. Despite the requirement to measure all the financial assets at fair value at initial recognition, an entity shall measure receivables and payables at the transaction cost as per Ind AS 115, except where there is a significant financial component in the trade receivable amount, and entity opt to apply practical expedient as per the state. Firm commitment to purchase or sell goods or services are generally not recognized under Ind AS 109 until at least one of the party has performed under the agreement. For example, if a order is placed for goods and services, there will not be any recognition at the time of commitment for placing a firm order for goods and services. And entity will delay the recognition until the ordered goods or services either have been shipped or delivered or rendered to it. So, till the time it has been shipped, delivered, or rendered as per the case may be, there will not be any recognition at the time of commitment. Similarly, if a party has received a firm order for goods and services, it is not going to recognize at the time of the commitment of receiving the firm order. However, it will delay recognition of AR and sale, etc., till the order has been shipped, delivered, or rendered. A forward contract is a contract which obliges one party to buy and the other party to sell the asset that is subjected to the contract, and for a fixed price at a future date. So there is a commitment date for the transaction and accounting to be done on the commitment date, not on the date of settlement. Normally, the value of the forward contract is zero at the time of inception, so there is no recognition at the time of inception if the net fair value of the contract is zero. But if the net fair value for the forward contract at the inception is not zero, then we need to recognize it at the inception. For the cases where the net fair value of the forward contract at inception is zero, there are chances to become net assets or liability in future depending upon the movement in the value of underlying assets and liability. So when the net fair value of forward contracts changes from zero to positive or negative based on the movement, we need to recognize the forward contract. Option contract is a contract which gave one party to the contract right but not obligation to buy or sell asset that is subjected to contract for a fixed price and at a future date or during the period of time is called option contract. Option contract that gives right to buy is called call option, and contract that gives right to sell is called put option, and from the perspective of holder it is called purchase option or bought option, and the party who is having obligation to buy or sell is called retain option. And option is called in money when it would be in holder's interest to exercise it during the period of time of the contract or at a future date. And in opposite, it will be called out of money if it is not in interest of the holder to exercise the option. Similarly, another term that is used is deeply in money, where the contract is in so far in money that it is highly unlikely to go out of the money before the contract expires. Similarly, it is called deeply out of money when it is so far out of money that it is highly unlikely to become in money before expiry. And similar to other options, contract option is recognized when the party becomes when we become the party to the contract. The obligations or rights are arised. At that time, recognition is done. Planned future transactions that can be referred as a forecast transactions also are not assets and liabilities because there is no right and obligation because of the lack of the contract regarding the transaction. So these transactions are not recognized as per NDS 109. However, there are transactions those are entered as a hash of certain highly probable transactions, and these hash transactions are recognized under NDS 109. For example, a forex forward contract can be designated as a hedge instrument for highly probable import of goods. In this case, the import of goods that is highly probable is not recorded. However, a forward contract, forex forward contract that is designated as hedge is accounted as though probable transaction will take place. So this is all about the probable transactions accounting under Ind AS 109. If you have any question or suggestion, you may comment on the video or can send the query on the WhatsApp number given on the screen. Thank you.